Palantir, time to cash out. This should be an interesting article for me to react to in this video here today. I thought this would be a great subject because obviously Palantir stocks moved up massively. I haven't sold any of my Palantir shares here, still holding all 5,555 in the public account. And so I thought we'd discuss this. I'd go through the points they make here, tell you if I agree or disagree with them, and tell you if I'm planning on cashing any of my shares or not. Okay, by the way, if you basically are somebody that feels like you're going to hold Palantir stock through for quite a while, let me know in the comments section why you continue to hold Palantir and not cash out. I would love to hear from you guys in the comments section as well. Okay, so we'll go through all that. I thought it'd be important to kind of react to this article. And then the last thing we'll do here today is we're going to react to this video from a few hours ago. AI demand is still strong. It'll probably exceed expectations, says Bernstein's Stacy Rascon. So looking forward to reacting to that one in today's video. Okay. Appreciate y'all being here. Thanks for being subscribed. This should be a fun one here today. By the way, if you're looking to join my private stock group and get access to our Palantir Discord chat, as well as all my course curriculums and all my other chats and things like that, put that as a pinned comment down there today. You can go out and fill out that form, as well as access to 1000xstocks.com. You know, this is something Andre posted here today. I thought this was very cool chart here. Implied average, basically contract value here, and it shows Palantir versus the other companies, and you can see like Trade Desk here, you can see ServiceNow here, right? You can kind of go down the list, and so it's just fascinating how big the contract values are for Palantir versus others. And this is a stock we obviously identified in the private group back in 2022. It's just an incredible opportunity. There's so many people that just made some game-changing money in regards to this one, right? Alrighty, so let's start going through this. Palantir has officially joined the S&P 500 in September this year. This finally opened the door for institutional investors, mutual funds, and analysts to purchase a stock and increase their coverage, with the stock set to benefit from higher popularity and demand. The data analytics software company has been red hot this year, with its value increasing 2.86 times from $15 a share a year ago to $43 a share. On a year-to-date basis, Palantir stock is up 153% alone and ranks third among the best performing stocks in the S&P 500. So shows here Vistra company, 225% year-to-date gain, NVIDIA 172%, and there's good old Palantir 153. Although this is my first, by the way, huge mistake people make. I need to say this right now. Massive mistake people make. Don't ever make this mistake, okay? It's looking at a stock and saying, it's gone up a lot in the past year. It's gone up a lot this year. Therefore, it has to crash. It has to go down. Big mistake. Big mistake. Many times when a stock's on a run, a major run, that run can last multi-years. Just keep that in mind. You could have looked at NVIDIA stock last year and been like, oh my gosh, NVIDIA stock's up so much in 2023. This is ridiculous. It's up so much from the Q4 2022 bottom. It's going to have to crash in 2024. And then you missed 172% gain so far this year, which could be 200+% by the end of the year, right? Although this is my first coverage on the stock on Seeking Alpha, I've followed Palantir since its IPO in 2020. Even though I currently do not have any exposure to the stock, I'm keeping a close eye on the company, hoping to add some shares to the portfolio on weakness around $20 to $25. Right there's already a problem. You and everybody else. Do you think not everybody else wants to add Palantir shares at $20? Of course, everybody that knows anything about Palantir is willing to pay $20. You understand, you have people that are willing to buy the stock at any price, right? Look at this gentleman here today in the private stock group. He added 38 shares. He's up to 688 shares. You have people that literally buy Palantir stock week in and week out, month in and month out, and they buy and they buy. And they don't care if Palantir's at $10, $20, $30, $40. And so it just creates this massive buying pressure that's constantly on the stock. And then why do they do that? Because there's a lot of people that are convinced Palantir is going to become a $500 billion market cap, $1 trillion market cap. They believe this is going to be one of the most powerful software SaaS-related plays ever, right? And so when you're talking to these folks, to them, it doesn't matter whether they buy at $15, $25, $35, or $45, because they look at it and they're like, the bottom line is the stock's going 200 or 300 over the next 5-10 years. And so that's their viewpoint, right? And so you just got to understand, you and everybody else wants to buy at $20, right? Like no different than we would love to buy NVIDIA 50% down. Like I would love to buy NVIDIA 50% down from here. I would love to buy Meta. I would love to buy Google. like I love to buy Amazon. We'd all love that, right? But the problem is, sometimes in these special companies, you never get what you wish for here. With Palantir stock on fire this year and its Q3 earnings just around the corner on November 4th, let's take a closer look at whether it's still a good buy heading into earnings. But bulls generally argue Palantir's improving profitability could drive more gains in the stock price. Not really. Most bulls don't even talk about the profitability. I talk about the profitability, but most bulls are really talking about the revenue growth and the acceleration there. In contrast, bears point out to the potential revenue deceleration, particularly in Palantir trades at 29 times its estimated 2025 revenue, basically talking about a price to sales ratio here, right? Which, yeah, pull it up on 1000xstocks.com, compare them versus other companies, and you're going to find they trade very rich, right? I mean, you can look at a forward P, it's over 100 for Palantir, 72 for CrowdStrike, 27 for Salesforce, right? And so a lot of people say, hey, like these companies are trading way cheap compared to somebody like a Palantir. Well, if you're just viewing it on like a 1 year basis, sure, like there's no debating that, right? Palantir's business keeps benefiting from AI integration as a first step. And by the way, you know what I also have a problem with here is potential revenue deceleration. Well, you got to also consider there's a potential revenue acceleration that's still coming, right? We've seen quarter after quarter after quarter the revenue accelerate further and further and further. Who's to say we're not going to continue to see that trend for at least the next few quarters? That's something that should be considered, right? As a first step, let's take a look at Palantir's business, given the business is relatively complex and much of its software details are undisclosed due to secrecy of dealing with government. In fact, 60% of Palantir's revenue comes from government agencies, where the remaining 40% comes from the commercial sector, an area where the company aims to expand in operations further. Yeah, and the commercial business should it shouldn't even be close in regards to how big the commercial business should be 5-10 years from now versus the government business. The commercial business should dwarf the government business overall. And that doesn't mean the government business is going to go down, because that's going to keep expanding. It's just the commercial business is going to expand much more rapidly. Palantir's core business is based on three main segments. Gotham, designed for government and defense agencies, providing intelligence data analytics tools for national security. Foundry, a data integration analytics platform that helps manage, analyze, and visualize data. Commercial clients generally use Foundry across a wide range of industries. Apollo, a scalable platform for developers to build customer applications on Palantir software. Yes, and let's see, Gotham, Apollo, Foundry, and they're missing one. They're certainly missing AIP, but they're missing another one. Palantir generates revenue through two main avenues. Like most other software businesses, it generates revenue via licensing, charging subscription, or usage-based business model for its Gotham and Foundry platforms. In addition to licenses, the company offers consulting services, helping clients implement and optimize the software to address their customer requirements. The business model is based on a three-phased approach: acquire, expand, and scale its business. In the acquisition phase, Palantir targets new customers by offering initial implementations at very low cost or no cost at all. During the second phase, Palantir aims to hook the customer by addressing the customer's specific pain points. In the last phase, Palantir fully implements and configures solutions, allowing customers to create a symbiotic environment by adding their own software atop Palantir's platform. So here's the key point, right? He talks about acquire, expand, and scale. And he talks about, basically Palantir at first will be very low cost or no cost, right? Hook the person, hook the companies, and then, land a $20 million contract, $50 million contract, $100 million contract. Yes. But here's the thing. Recently, because of AIP, they're attracting a ridiculous, and I mean absolutely ridiculous, amount of customers. Now, why is that important? Because they're attracting all this insane amount of customers the past year, but they're not generating a ton of revenue yet from those customers. But let that play out over the next year, 2 years, 3 years, and you're going to start to see this ridiculous amount of customers they've been attracting. All of a sudden, the revenue is going to start to flow through in an epic way, right? And so that's what I think a lot of investors are looking at. They're looking at how right now, if you look at their revenue growth versus their customer growth, the customer growth is far outstripping their revenue growth, and it's not even close. And so a lot of people are looking at this and they're saying, watch that revenue continue to fly higher in 2025 and 2026, and maybe even continue to see reacceleration, where this latest quarter was like 27% revenue growth. Maybe next quarter is 30%. Maybe the next quarter is 33%, 36%, 39%, right? And then at some point the revenue peaks, but that's kind of the thought process there. Like most other software businesses, Palantir has been introducing AI into its product mix via AIP in the last quarters, harnessing the power of large language models for decision making. The first few used cases for Palantir are the integration of AI into government customers, particularly aimed at the intelligence gathering, counterterrorism, and military operations. However, the company is now aiming to leverage generative AI to drive growth in the commercial part of the business. In my view, Palantir might be one of the key potential beneficiaries of generative AI. Its core strength lies in its ability to integrate and analyze large volumes of data to train models in decision making, aligning perfectly with AI's need for high quality, well-structured data for efficient model training. So, right off the bat here, I gotta say, in regards to this article, this individual, I gotta say, they do understand Palantir. We might have a disagreement about valuation and kind of looking at it from that standpoint, right? But I don't get, because a lot of times, somebody will say something negative about Palantir and it's like, they don't even understand the business model. They don't understand anything that's going on here. This individual, I think they definitely understand what's going on in the business model. I do think they are well educated on that, right? But, we got some other issues to address here. As we are just 3 weeks away from Palantir's reporting its Q3 2024 earnings, let's briefly look under the hood of Q2. In the second quarter earnings report, Palantir exceeded Wall Street expectations on both the top and bottom lines and issued better than expected Q3 guidance, with strong performance responsible for the red-hot year-to-date performance in the stock. For Q2, Palantir reported GAAP earnings of 9 cents, roughly 80% increase year over year. Yeah, and that's the great thing with Palantir's bottom line. We're at the infant stage. The growth rates in that business over this next few years is going to be ridiculous. It's going to so far outstrip the revenue growth rate. Revenue rose 27% to $678 million, beating analyst expectations of 8 cents and 6.53. Both the government and commercial businesses performed very well during the quarter. The government business generated $371 million in revenue, up 23% from the analyst estimates of $349 million. Its commercial business has delivered even better performance with 33% revenue growth and revenue of $307 million, ahead of the forecast by $1 million. Commercial revenue growth was significantly helped by a substantial 55% growth in U.S. commercial revenue, which reached $159 million. Palantir's future demand depends on its success in growing the commercial segment, which is gaining momentum as the company strengthens its expansion into financial, healthcare, energy, and moving away from government-dependent revenue structure. Even though the government-based contracts are more guaranteed and less cyclical, most of the money is to be made from the commercial segment. In fact, Alex Karp said in a shareholder letter, highlighted that Palantir's U.S. commercial customer base has increased 83% year over year. And here's the thing. Was their revenue up 83%, even on the commercial side? No. So there's a lot of revenue gain coming in 2025 and 2026 from a lot of these customers they're attracting. From 161 customers in Q2 2023 to 295 as of Q2 2024, now making up half the company's total customer base. Top and bottom lines growth do not disappoint, right? It talks about, obviously, the revenue growth rates. Now, he says, nonetheless, given the strong tailwinds the business is experiencing, particularly in the U.S. commercial segment, I expect the company to beat its revised guidance by the end of the year. I expect a further 20 to 23% annual revenue growth on tap for subsequent years. So right at the bat, okay, so let me say this about this gentleman and his 20 to 23% growth. If Palantir only grows 20 to 23% per year over the next few years, he's right. He's right. Palantir is overvalued. It will be dead money for a few years. There's no debating that. And let me show you why. I think it's very important to show you why here in regards to valuation. And this is why Palantir's, whether they're growing 20% or 30% or 35% revenue or 40%, right? It's going to change things epically here. So if we run, so let's go ahead, let's type in Palantir, and you're going to see why growth rates matter so significantly. So let's say Palantir only grows 20% a year from 2025 to 2028, right? And let's say net income definitely outstrips that. Let's say they grow net income at 35% clip, right? Which is significantly above the 20% revenue growth rate. Now, if you slap a 40, we'll say a 40 to 70p, just so you guys can kind of see a nice range here. 40 to 70p on this baby. 70, 70, 70. So In this sort of situation, the stock would be dead money for at least the next 2 to 3 years, essentially, right? If the company only grows revenue at a 20% clip, right? And they grow net income at, let's say, 35% clip, getting to net income margins of 35%. But there's a big question if the company is really going to be only growing at 20%, because we just see their revenue growth accelerating, right? And then we know we're attracting so many customers that that's going to end up turning into revenue over the next few years. So if all of a sudden you start to think about this company as, let's say a 30% grower, right, on that top line, and all of a sudden we say maybe closer to a 50% growth rate as far as the bottom line here, right? So let's run 50s across the board. And I mean, if you're growing 30% top line, 50% bottom line a year, you're commanding a PE easily of somewhere between, you're commanding a PE somewhere between probably 90 and about 120. If you're growing 30% a year top line on average on a SaaS company and 50% bottom line, 90 to 110 easy. If you're growing at those sorts of growth rates per year, right? And people can count on that, because that's just ridiculous if they were to average that over the coming years. And then you begin to understand all of a sudden 2028, the stock's somewhere between about $124 and $152, right? Which gives you a compounding annual growth rate of 30% plus. This is why revenue growth rates matter so significantly. So this gentleman that wrote the article, he's 100% accurate if the company only grows like 20%-ish per year over the coming years. Like this stock, like it would make sense to cash it now. If you're convinced only 20% growth for the next few years for revenue, it does make sense to cash the stock in the 40s. No debating that. But if you start to talk about a 30% or above a 30% revenue growth rate, it significantly alters the way this company's going to be valued, which then it doesn't make sense to cash the stock at $40. It just doesn't, right? This is why this next quarter's numbers are going to be so darn important. Even as many growth companies prioritize revenue growth, leaving profitability in the back seat, or straight out failing to convert revenue into earnings, that's undoubtedly not Palantir's case. From what we can see below, Palantir's business became profitable on the operating level only in 2023, but operating income has continually expanded, driven by higher revenues and margins. No doubt, the chart's self-explanatory there. Palantir's operating margins have been continuously improving thanks to attractive unit economics the business can generate from the existing user base by upselling new products. I see margin expansion as a likely path as a company as it continues to grow. Valuation might act as an anchor on future returns. The issue with Palantir's business is not the business itself, but the valuation. An issue we face and investors face in many quality companies. Palantir's management expects fiscal year 2024 sales to land $2.75 billion, which would imply a price to sales ratio of 35 times, given the $97 billion market cap. Analysts are expecting forward 2025 sales to land $3.32 billion, year-over-year growth of 22%, implying a 14-month forward price to sales ratio of 29 times. Now, the rich valuation, and by the way, price sales ratio, I really don't love that for valuing a company that is now profitable. Like Palantir is now profitable, it should stay profitable. I like valuing much more on a forward P basis or a 2-year forward P basis, which is something we have on 1000XL. Like no one else has this. I don't know why other services don't provide, because analysts run numbers to 2 years out. And that 2-year forward P can be very, very helpful on stocks, right? So, just something to kind of keep in mind there. As far as earnings go, fiscal year 2024 earnings per share, they have 35-cent estimate, year-over-year growth 42%. 2025 earnings per share, 19%. How do analysts think this is okay? They have earnings per share growing at a slower clip. We know Palantir is probably going to buy back a bunch of shares. And we know they're at the end stage of profitability. How do they have earnings per share growing slower on a percentage basis than revenue? That makes no sense. No sense. They're still going to be generating crazy amounts of money from treasuries as well. So if you're banking on treasury money being gone in 2025, that's not realistic, because a lot of times these companies lock up treasuries for 6 and 12 months. So they're still going to be making bank off treasuries here in the short term. So that's just wild. And then the following year, only 21% growth. What are they doing? Like literally, what are they doing with these analyst estimates here? The growth we can see is indeed categorized Palantir stock as a genuine growth company. Still, the 20% earnings per share growth expectations beyond fiscal year 2024 are, from my perspective, not enough to justify the exuberant valuation stock carries. Yeah, once again, if Palantir only grows earnings per share 19% in 2025 and 21% in 2026, yes, the stock's a sell at $40 plus, 100%. No debating that. But who's running these numbers as analysts? Like, I would be extremely disappointed if Palantir was anything under like a 35% clip. But I'm expecting more in the 40 to 50% earnings per share growth in 2025 and 2026. That'd be extraordinarily disappointing. No way, man. No dang way. Like, that's wild. Like it looks like the analysts are probably going to be way too low in their revenue estimates. But the earnings per share estimates are just laughable. What are they doing with these numbers? Let's look at the following scenarios. How much does Palantir's bottom line need to expand for the remainder of the decade just to justify buying shares at today's price? In scenario one, if we assume the projected fiscal year 2024, 2025, and 2026 growth materializes as expected by analysts, and the company grows its EPS at 30% annually for the remainder of the decade, Palantir would need to trade at least 40 times its PE by the end of 2029 to just break even on your money. 100%. There's no debating that, right? So, given the non-existent margin of safety for uncertain future growth, I would aim at least a 20% ROR to justify buying Palantir shares at today's valuations. If we stick with the same growth assumptions above, Palantir shares would need to trade at 100 times its earnings by the end of 2029 to deliver that. So, yeah, 100%. There's nothing I can argue with here in regards to kind of the valuation talk. Like if that's all you're expecting, if all you're expecting is this company to basically do 20% revenue growth and 20%, net income growth or earnings per share growth, however you want to categorize it over the coming years, there's no way I can win against that. Palantir 100% is a sell today. 100% if you want to run numbers at only 20%. I just think they're going to probably do bigger numbers than that, right? So here you go. Boom. And run it at, you're going to probably command I would say 40 to 60 PE if you're growing at those sorts of growth rates and you're in the SaaS space, right? So you can see the stock will be dead money. Dead money for years, right? What did I do wrong here? Oh, I did PayPal. I'm sorry, Palantir. There we go. Yeah, I would love PayPal to grow 20% top line and 20% bottom line over the coming years. Oh man, I'm going to be doing well for myself. Let's just put it that way. But in regards to Palantir here, yeah, you can see it's going to be a negative returner over the coming years if that happens, right? So no debate. But what do you expect the company to grow? And that's what you need to ask yourself in regards to Palantir if you're thinking about cash in the stock or not cash in the stock. What do you think are the growth rates of this company over the coming years? Do you think they're going to get back to 30% plus? The trend is certainly that way. Doesn't mean they're going to get all the way back there, but the trend is certainly keeps going higher and keeps going higher. And we've had, 4 straight quarters, I believe now, of accelerating revenue percentage growth. So at some point that trend will break, but when does it break? Is it when it hits, is it last quarter? At 27%, is that the highest they get? Is it next quarter, maybe they get to 30%? Is it the following quarter if they get to 33, 35%? What if they get to 40%? These are all things that should be considered because I can tell you if all of a sudden the company starts growing at like 40% clip, night. Like Palantir's got a long way to run in that situation, right? That's what it really comes down to in regards to the stock. All right, next one up here, AI demand is still strong. Will probably exceed expectations.
From yesterday's broader chip sell-off on the heels of a disappointing earnings leak from ASML, that stock is still sinking today. NVIDIA also getting hit with news that the DOJ is considering capping AI chip exports to some countries. Joining me now to discuss all this is Bernstein Research's Stacey Rascon. Stacey, it's good to have you here. It always sounds like there's a ton going on around NVIDIA. Certainly there is. Not to mention we have, Jensen is really, on the circuit out there, kind of preaching the future at every turn as well. And yet the stocks, it's up 0.7% this week. It's kind of hanging in there onto this gain. So separate out what matters and what might not for this one.
Yeah, you bet. So yesterday took a hit along with the rest of the sector on 2 things. One was the the ASML earnings leak, which was interesting in its own right, and some of the export control news. I think any hit that it took on the ASML report was probably not really justified because while ASML's report, as we all know now, was not great, the one sort of bright spot from it was AI demand. It seems like AI demand is still off the charts. It's about the only thing that is, but it's still very strong, and clearly like that benefits NVIDIA. I do wonder if some of the hit yesterday was more around some of the export control stuff, and what's going on there is there were some stories that suggest the U.S. is considering, I guess they suggested capping the licenses that NVIDIA and other AI chip vendors can use to sell parts to other countries, particularly, I guess, in this case, the Middle East. I'd say, and though I'm not sure it's that big of a deal, I guess we'll see, but caps, in my opinion, are not bans. They already have they're already under licensing arrangements with the Middle East. They have to get licenses to ship there anyways. And frankly, the other outright bans that we've seen in the past haven't really slowed them down at all. So I'm not terribly worried about that. They seem to be more incremental than anything else. And we saw the stock yesterday was coming down before the ASML. They dropped sharply and then kind of recovered a little bit afterwards. And so I think today it's kind of relaxing a little bit as it's clear that the ASML news is not a direct read across, and maybe the export control stuff isn't as big of a deal as people might have been worried at first.
Yeah, people made way too big of a deal of the ASML situation there in regards to selling machinery, right? Just because their demand for selling machinery because you got to understand, they're a massive machinery maker. That doesn't mean NVIDIA's numbers are bad. Where do people make these things up in their brain about in regards to this? That doesn't even make sense. To assume NVIDIA's numbers are going to be bad, because I'm watching the guys on Fast Money last night, and some of them are questioning NVIDIA because of ASML's earnings. I'm what are you doing, dude? You realize there's a billion different semiconductors in different companies out there. NVIDIA's already said demand's great. We know demand's amazing for NVIDIA. And we know demand next year for NVIDIA is going to be amazing, right? 2026, 2027, you could begin to ask questions. But to assume I don't know, they're fairy tale fantasy of NVIDIA's growth is just going to stop right now. No. They're good. They're good for this year. They're good for next year. If you want to talk about 26, 27, you can talk about that. But don't act like right now they're no one's ordering NVIDIA chips. What are you doing?
Clearly, as you suggest, making its peace with whatever all this is. And I know there's a way also of saying, listen, this stock is where it traded 4 months ago. It had an absolutely massive run. It gets to $3.3 trillion market cap. And then maybe it needs to kind of hang out for a little while and figure out exactly how long we're going to be in this lucky position of demand outracing supply into next year. So where do you think that sits in terms of investor expectations and how the stock is positioned?
Yeah, it's interesting. You sort of look at the last couple of months, it was in a lot of news flow. The stock took a big hit several months ago on the Blackwell delay rumors. And while it does seem that there were some issues there, it really looks like they've worked through without any problems, right? So it didn't really have any impact on the demand trajectory. And I'd say since the stock I went to $90 or something, close to it. And so it certainly recovered off of that. I guess that was a great entry point in hindsight. And look, going forward, all of the checks on AI demand, like I said, they're going to sell everything that they can make. And you mentioned Jensen's out there. I think he's been on your channel more than once in recent weeks and sounding very enthusiastic. It's the one bright spot in the whole semiconductor arena right now. It's the one thing where we can definitively 100%. Point and say demand is probably going to exceed expectations, even expectations that I think are going up now. Mm-hmm. Some of the other areas in semis, I wish you could say that. You can't really say that right now.
No, for sure. Well, speaking of the other areas of semis, we also have these reports that, maybe Qualcomm, if it is considering some kind of a bid for Intel, might be waiting till after the election.
We'll see. We'll see about that whole situation, okay? Appreciate you guys joining me as always. Thanks so much for being here, folks. Hope you enjoyed today's video. Once again, let me know your opinions on Palantir stock in the comment section if you feel like it's a sell now or a hold. If you're looking to join my private stock group, get access to our Discord chat as well as all my course curriculums, including our Palantir chat, click the pinned comment down there. You can fill out an application. We'll see if we can get you in there either this weekend or maybe next week. Wouldn't you love to join us in there? I think you would. Much love and have a great day.